Banks are one of the most powerful players in any economy, yet many people don't fully understand what they really do. At their core, banks are not just places to store money. They are financial intermediaries that connect people who have extra money with people who need money. This simple role allows economies to grow far beyond what cash alone could achieve. When you deposit money in a bank, the bank keeps a fraction of it as reserves and lends out the rest. This process is called fractional reserve banking. It means that banks can effectively create money by issuing loans. For example, if you deposit $1,000, the bank might lend $900 to someone else, who then spends it. That money eventually ends up deposited in another bank, which can lend most of it again. This cycle allows a relatively small amount of cash to support a much larger volume of economic activity. Credit is simply borrowing money with a promise to pay it back later, often with interest. Credit can take many forms: loans, mortgages, bonds, or even credit cards. It allows people and businesses to spend or invest money today rather than waiting until they have saved enough. Debt, on the other hand, is the total amount owed to lenders. Debt can be a powerful tool for economic growth if used wisely. For example, a business can borrow to buy machinery that makes it more productive, creating more value than the original loan. Interest is the price of borrowing money. It compensates lenders for the risk of lending and for giving up the use of their money temporarily. When interest rates are low, borrowing is cheap, encouraging spending and investment. When rates are high, borrowing becomes expensive, slowing spending and encouraging saving. However, debt also carries risks. If borrowers take on too much and cannot repay, banks can suffer losses, which can ripple through the economy. History is full of examples. Financial crises often start with excessive debt and risky lending. Banks, credit, and debt together act like the bloodstream of the economy. They move money to where it can be most productive, but only if the system is managed responsibly. Understanding how banks create credit, how debt works, and why interest rates matter is key to understanding modern economies. It explains not only how people buy homes or start businesses, but also why booms and busts happen and how policymakers try to keep the economy stable.